Hello, my name is Theandra Gibbons, and I will be presenting over Walmart. I'll be presenting over Walmart today, and I'll be going over the cost of capital. I'll be going over the budget analysis and everything. So let's dive right in. So right now we have on the screen Walmart, and we have Walmart on the screen right now. And so basically what we're going to be talking about is all of Walmart's information and everything. So I made this little collage with Walmart and the Walmart logo and the employees. Okay, so first we're going to start about how I got my data. So how I got my data, here's my references. How I found my information is over here. So what I did was I just went to Yahoo Finance, and so on Yahoo Finance it had everything that I needed. So what I did was to collect the data for the Walmart data sheet, what I did was I went to Yahoo Finance and I went to, let me zoom in a little more. I went to the Yahoo Finance website, and I have the link right here. And what I did was at the time I put, at the time it was April, so I had to update some of the information to make it accurate. But I put May 1st, 14 to May 1st, 2019. So when I updated the data, I put in the correct information. And then I put historical prices, and then I put monthly. And this showed me the open, the high, the low, the close, and the adjusted lows and the adjusted close. For this information to be accurate, we're using the adjusted close. So this is for the S&P 500, which is my data spreadsheet here. And what I did was I highlighted the information that I'm actually going to be needing. So of this information right here to my left, I just put it over here to my right. And so for the Walmart, I just scroll down. We see the stock price, and I did the same thing. I did the information from May 2014 to the May 2015, which is 5 years. And then I did my historical prices, and I did it for monthly, and then I applied, and then here's what I got, all the information here. And so I highlighted the information onto my right of the information that I'll be needing for my next tabs. So the next thing we're going to do is we're going to calculate the beta. So how we calculate the beta is, like I said here, from the data that I got from Yahoo Finance. I used the date, of course, to see when everything happened, and then adjusted close. And then what I did was, to get the return, what I did was I subtracted the month prior. I subtracted the current month. So at the time when I got the data is April, because that's when I started my analysis, was in April. So I got the April information, and then I put it, got the information, and then I divided it by the month prior, which is March, and then I subtracted 1. And so that's how I got my return. That's how I got my return for basically every month. So it's seeing, what did you, from last month to this month, what was your return? What was your adjusted close? Like, what was your return? What did you get off of it? And so we see that it was a negative, and it's really small amounts of returns, but it's mostly, a lot of them are negative, but some of them are positive. So then I scrolled down and I got the average return, which will help me find my beta. And so what I did was I did the same thing for the market. So this is going to help me later in my project for the market risk premium, to see what is the return on the market. And so, and then at the end I averaged it. And so when I went over here to do the beta, I used the slope formula, and the slope formula is basically saying, it's comparing the returns from Walmart to the market. So what is Walmart returns and what is the market returns? And as you can see that the Walmart returns are beating the market, which is good. That means they're not doing worse than the market. If this was a negative, this will be a different story. That means they're not, the market is giving this amount, but this company is not. So we see that we got a very low beta over here. Usually average betas are 1. This is way below 1. So this is saying that it's not as risky company. It's saying how much does it move around them. Well, that's the variance. Okay, let me not go too far, but that's the beta. And so what I did was I used the information. We used the information by using the data analysis to find to run the regression. So in the data analysis, I used the same two columns: the return for Walmart and the return for Standard and Poor's 500 or S&P 500. And then when I put in my information, and I ran the regression, I see that I got the same exact beta, and that's called X variable 1. All right, and we see all the observations and the significance of F and everything. Okay, let's move on. So, on to my next one. So, now the next thing we're going to do is cost of debt. So where I got my information was FINRA, which is the Financial Industry Regulator Authority. And what this is saying that I can look up like all the bonds, like so the corporate bonds, treasury bonds, I can look up all of this information. So what I did was I used the information that I got from FINRA to see what are the yields on the corporate bonds of Walmart right now. And so why this is important is that I'm comparing the bonds to these bonds and what I'm getting my yield off of. And the yield is saying that if I was an investor and I was to invest in Walmart bonds, how much would they be paying me? So on here, it's showing that I found, so as you can see, there's two pages full of yields. And so they're all different maturities. We see here some are maturing 2030, some maturing 2023, which is only 4 years from now, a little over 4 years because it's, October. And then we see some mature in 2037. So the ones that I was looking for was 10 years and up. So ones that are going to mature in 2029 and up. So as we see, 2037, 2038, these are the ones that are on my spreadsheet. And so what I did was I see the yields are almost the same. They're very small margins. They're only like a 0.02% difference or a 0.2% difference or 0.3. They're very small. So what I did was I took the average and took the average cost of the debt. And what I found is that the average cost of debt, or basically the yield that they're going to be giving the people that buy these bonds. So my cost of my debt is, because a bond is a debt instrument, so they use it to raise money. So they have to pay people back, and they pay people back in very small amounts. 3%, it's not a lot for your return, but that's what they do. So they're going to basically give the people that invest 3.68%. So that's what I got for the cost of debt. And if we keep going along here, so let's move on to cost of equity. So my cost of equity, I got this from the same website, FINRA. So this information, when I pulled it at the time, like I said, I did a lot of this back in April. And early of this month, and I should have put the information in on that timing, but I waited till today to post the information because I didn't think it was going to update that fast. But it's the market, so it does update. It updates fast. So last update was actually today. So some of these bonds prices have changed, but at the time the 10-year treasury bond was 2.54, and so now it's down to 2.40. Okay, it changed a little bit, but that's my information is based off of early May and at the end of April. So at the time it was 2.54%, but I still got it from this website, which is FINRA. And so we're going to look at the risk-free rate. So we're going to look at 3 different methods to find the cost of equity. And these are basically to your people that have your bonds. And so what does it cost to basically invest, I guess? And so the risk-free rate is saying that the 10-year treasury bond is 2.54. So risk-free rate is saying that these bonds are basically risk-free. So if So they're basically risk-free. So these are kind of like your risk-free. So they're usually the lowest ones. And so you see that they're getting, if you invest in corporate bonds, which are more riskier assets, you get 3.68 out of Walmart. But you see here in Treasury, you only get 2.54. So we see that the more risk, of course, the more reward. Okay, so the next thing we're going to look at is the beta. So that's the beta that we got from our beta using slope, remember? So I linked the cells here. As you can see, it's from the beta using slope spreadsheet. And so what I did was I just put the equal sign and then I put it there. So I linked the cells together. So if my beta changed or something, maybe I did redo the calculations, my beta changed, then all of it, then this page changes as well. And then we have down here, I use the same thing from the expected return of the market. All that it is you can see is beta using slope, G63, which is right here. G63 right here, which is the return on the market, which is just the average return on the market for the S&P 500. Okay, and then that gave me a CAPM, and so how I calculated my formula was B5, which is the risk-free rate, and then what I did was I added that the B minus 7, which is the expected return on the market, minus the risk-free rate. So it's risk-free plus the expected return on the market minus risk-free times the beta of my company. And this gave me and this gave me a CAPM of 2.37 cost of my equity. So as we go down to my discounted cash flow, we see the stock price as of May 7. Of course, they change every single day, but as of May 7, we see that my stock was $101.30. So right now we see that it's at $100.29. So it's changing very slightly. But at the time of May 7th, when I did this, it was $101.30. And so my forward dividend. So what I got my forward dividend is that I looked on the Yahoo Finance and I looked under the summary and I saw that the forward dividend was 2.12. So that's what they're expecting the dividend to be basically at the end of this year, which is your D1. And so what we do is that we see that the dividend was $1.56. $1.56, which I have here. How I got that $1.56. So what I did was I multiplied the 52 cents that we're giving in December 2008, August, and May, and that's the information that they have shown here. As you can see, that from May 2018 to May 2019. Here's the dividends that were listed, and so when I multiplied that times 3, and that gave me basically my 2018 dividends, which was $1.56. So what I did was I subtracted the future dividends and I subtracted it from the dividends that I got in 2018, and then I divided it by the dividends of 2018. So basically like the percent change formula. Okay, and then they give me a required rate of return of 2.09. So it's saying that from the discount cash flow model, if an investor is using this model, then what this is saying is that they should be expecting 2.09%, which is not so good because we already see that the Treasury can get 2.54 at the time of the beginning of May, right? So then when you look at the bond yield, so this is saying the bond yield, which is the cost of debt. Like I said, as you can see, the cost of debt is what I linked the cell from. And then the market risk premium. And the market risk premium is just B7, which is market risk premium, which is just B7, which is linked from the S&P average return from the other sheet. And then we see that we have that the average. So the cost of equity, I just equally weighted them. So what I did was I just add them all up and then just averaged them. And so that's what I use for my cost of equity, was basically 2.02.